Hi everybody, welcome to another update on the gold forecaster index, the holy grail to predicting gold prices. In my last video I said that gold would be almost flat and go up a tiny bit, and that's exactly what happened. Gold is going up a tiny bit. So that's again right. I have been right for at least 5 videos, and we are going to see what's going to happen next month. So we're going to go through this gold and silver checklist, but I'm going to premiere a new experiment of mine, which is the gold forecaster index indicator. And what I did is I took all of these indicators from the gold and silver checklist, and we're going to go through each and every one of those and assign a number to them. It's either 1, 0, or -1. So if it's positive, it's 1. If it's negative, it's -1. And if it's flat, then it's a 0. And then you just do the sum of it, and then you have your gold forecast index indicator. Now, of course, not all of these indicators have the same weight. So here I assigned some weights to them. For example, I think China demand is pretty high weight, 6. But US mint sales, for example, is basically insignificant, so 2 weight. And then I just do multiply this with this number with the weight, and then you get this number, the weighted gold forecaster index indicator. And this is the sum of every indicator here, and then you get a chart. I'm hoping to get some data here in time and then see if there's a correlation between this indicator and the gold price. Okay, so let's see. Today we have a gold price of 3381, 3381, 5 August, and we're going to start. Technicals. Normally I don't look at technicals, but I think it's important to be a hybrid. Fundamentals plus technicals are good. So I see here, and I'm not a technical analyst, I see that it's up, down, up, down, up, down, and I think it's going to go up, right? It's probably going to break out. We had this one, head and shoulders, breakout, and now this is a trend going up. So I think technicals are looking good. Yes, there was also some triangle pattern here, and we're either breaking down or breaking up. I think it's going to break up. Okay. So technicals, I will give a 1. Gold forecaster index, let's see. The gold forecaster index is apparently negative now, probably because of less deficits. Yeah, we had a lot of deficits a few months ago because of the imports that went up, and now we need to get to the negative side again. So less deficits. I will give it. Yeah, that's a difficult one because you need to take the average of the both. That's 0. Put it at 0. Taylor roll rate is still above 0, but it's down a tiny bit, as you can see here. I think it's still positive. Misery index. Actually, misery index should be positive and not flat, because the unemployment rate is actually going up right now because the participation rate is down. So actually the unemployment rate is now close to 4.8, not 4.2. So actually this should be going up, and inflation, everyone knows that inflation is much higher than they say. So this should be 1. Real output is definitely going the upwards way and with a minus sign, so that's also positive. Gold ETF demand, yeah, it's up a tiny bit, looks like it's going higher, so I will put 1. GLD flows is also starting to head higher with the head and shoulders, so 1. COMEX flows, oh, this one is good. This one has bottomed out, starting to go back up. So it was negative, yeah, it was flat, but now it's, you could say it's still flat, but I'll give it a 1 because it's starting to bottom out. COMEX gold deliveries, it was down, but now it's going back up. I would say this is now back to flat. LBMA flows, I don't have new numbers yet, but looks like this is bottoming out. It looks positive. China SGE deliveries still negative. I don't have new numbers. India imports also negative. See, both charts are headed down. Then Shanghai gold inventory flows are extremely positive. So that's a 1. And this started to happen somewhere here where gold started to rise. So this should be a sign to go higher. Okay. Central bank demands. I guess central banks are still buying. So 1. Next one is China central bank buying. They are still buying, but not that much, but it's still buying. Okay, so it's 1. US mint sales are very bad, -1. Shanghai gold premiums. Shanghai gold premiums are actually at 0.4%. As you can see here, 0.4% is positive. So back to +1. UpMex gold premiums certainly negative. Same with the silver premiums. Nobody is buying, so the retail is not buying. They don't have money to buy. COT long positioning. So if this goes down, that means that the longs are increasing. So that would be positive. So this is still trending down, which means the long positions are going up, which means this is positive. Open interest. Open interest was starting to bottom out here. So actually this is positive. If this goes like this, then gold will go up. Seasonality. This is the real yield. Real yields are starting to move this way, so that's good for gold. Same here, starting to move this way. With rate cuts, this is going to accelerate upwards. Seasonality is indeed positive because we're in August. So 1, real interest rate trend is actually starting to go up because we know that they will cut rates. Gold miner sentiment. Gold miner sentiment. Let's see. is very bullish. We are above 70, so there could be some more upsides in the gold price. Typically, this is a top, but yeah, the sentiment is now headed upwards, so that's a positive. If it starts to go down, then probably it's going to be negative. Currency in circulation is actually moving up. You can see the blue line moving up. It's a tiny bit, but it should be positive. 30 to 10-year yield ratio. Making an all-time high, as you can see here. So the 30-year yield is much higher than the 10-year yield. And this is actually very important. So this chart is starting to break out, which means gold is about to go much higher. We are currently somewhere here at this point, and gold went up 50% in 2020. So I guess we could see another 50% today. That's going to bring gold to 5,000. Okay. This is the second derivative. Yeah, it's down a bit because this is the derivative. But it's still above zero. So this is definitely a one. Google Trends. Let's see. Oh, look at this. Everyone is going to buy gold. I probably need to post a tweet on this. So this is positive. The next one is, it looks like a lot of things are positive. Debt to GDP, yeah, debt is at 37 trillion. This is certainly positive. Near-term forward spread is also positive. I just did a tweet on that. You can calculate it yourself. It's currently at -1. So deep in a negative, which means when it goes back to positive, then gold will go up. Just showing you these two links first. So the near-term forward spread is basically this thing here. You need to take 18 months further, so that's January. That's 3.23% minus the current 3 months yield. Treasury bill is 4.3, so this minus this is -1. Okay. Same here. You can just take this number minus this number. That's -1. So very nice links. And this is a 1. Rate cuts. Yes, we are going to get rate cuts. Let's check on it. Yeah, so we are currently at 2-year yield 3.69, and the Fed funds rate is at above 4. So they need to cut rates. If they are much too late, they will cut rates next meeting. Okay, one FRBNY deposit trend. This one is flat. No gold buying to be found in New York. Deposits, so 0. Borrowing fee. The 0.5%. That's not a lot. You want to see this kind of move. This is nothing. So, but there's a tiny bit of green, so I would say it's a 0. Gold futures curve is of course up. It's always up. Fundamental gold price. Yeah, so this is the gold futures curve. Looks pretty okay. fundamental gold price. Okay, here. So you can see that the fundamental gold price has weakened over the last month, even going negative here at this point, but now it's back up. Is this positive or negative? It's certainly not negative, but it's not really positive either. So I would give it a 0. Yeah, the daily gold target. Let's see, I think it's just the same. Yeah, we're still going to go to 5,000. And we have a consolidation here. The more it consolidates, the faster it will go up. Okay. So this is a plus. Geopolitical uncertainty. Yeah, there's a lot of geopolitical uncertainty with all these tariffs. Deficit trend. Yeah, we will look at the deficit. Yeah, you can see that deficits went up here and now it's back down. So we need to take the average of the two. That's because of the tariffs. It's still down on average. So deficits are increasing. Yeah, the average between these two is somewhere here. So yeah, the deficit trend is widening. We know that the budget deficits are also increasing. So, and here the services flat, that's good. Yeah, here, look at the blue lines. Blue lines are headed back down. So that's also confirming that the deficits will go up this way. Import price index, yeah, still deficits, more imports than exports. Import price, export prices apparently higher than import, but this is for all commodities. Yeah, looks like prices are headed up. This is GDP, and you can see imports down, but exports the same. Okay, so less deficits. And then, yeah, this is difficult to see because of the skewed graph. But deficit should go this way, and the US dollar should go down. Okay, so overall, I think deficit trend is still positive. So we have filled in everything. What do we have? The gold forecasted index indicator is going up with the gold price. That's pretty logical. And here the weighted one is also headed up. Now these are only 2 data points. We need to get more data points to see the trend. But it's a start. And it's up. So the weighted gold forecast index indicator is up by almost 15%, which is good. So the trend is going more positive. Okay, let's take a look at some blog posts. Yeah, China home sales are not doing that well. Not good for commodities, so stay in gold. A new indicator, the job gap, which is the employment level plus job openings. This is the demand for jobs minus the supply for jobs. So there's a job gap, and it can actually give you an indication of whether you have a recession or not. If this goes negative, then you will get a recession. Unemployment rate will go up. So we are almost there. We're almost negative. We will see if this will go below zero. I have also added this graph to the non-farm payroll tab here. So lots of data that you can find on jobs. Jobs are going down apparently. So the trend is starting to go down. Job postings still in a downtrend. Link up data also in a downtrend. This is actually improving. The unemployment rate's starting to drop a bit. And this is the chart that we saw earlier. Let's look at this one, real unemployment rate. Yeah, this is an important chart. As I said, the unemployment rate is actually not 4.2, it's 4.9 if you include the participation rate going down. So that's why I said the misery index is going up. Road to 10,000 gold. Let's look at some of these charts. Real rates are starting to move back up. Okay, that's positive for gold. And this is the same chart but zoomed in. Looks pretty positive. The dollar is going to crash and gold will go up. Gold miners are still cheap and will go up relative to gold. And gold miners vs S&P is still at bottoms. So this wave will eventually go this way, and that's positive for gold. Non-farm payrolls were not that good. You can see here, this is the forecast, and this is the result, the blue line. And they also revised the previous months much lower, as you can see here. Revisions are the largest in over 2 years. So it's not looking that good for the jobs market, which is good for gold. Gold vs stocks. Yeah, this is also important. This is the Warren Buffett indicator, market cap to GDP, which is at all-time highs. This will eventually move back down. So that means that stocks will underperform. And this is the gold price vs S&P. This will eventually go the other way. So gold outperforming stocks. Okay, this is a 10-year trend. So normally this wave should last at least 5 years to 10 years. Okay. So just position in gold miners and they will probably go up or outperform stocks. Real GDP is indeed slowing, going down, probably going into recession. And you can actually find this on Fred website. and check it. It's apparently going down. If it goes below 0, then we have a recession. I have added this to the stock forecaster tab, so you can just go to the stock forecaster and look at all of the data here. Plenty of data to check if we are going into a recession or not. Next one. So we're still early in the gold bull market. As you can see, this is the GDX. Nobody is invested in GDX. This is the amount of shares outstanding is at lows, even though the price of GDX is at highs. So if this returns back up when all these investors get back in gold miners, this is going to go much higher. And this is GLD vs S&P, still at low levels, headed upwards. Who is paying the tariffs? Also eye-opening. You can see that, yeah, this is US importer percent tariff paid, and this is the amount of, yeah, this, let's see what all this data is. Consumer percent tariff paid. Yeah, they pay 30% of that. And the US importer pays the other 60%. So Americans actually pay this plus this. It's 90%. And basically, yeah, the Americans are paying for the tariffs, basically. The tariff rate is currently at 18%, which is pretty high when you look at history. And this is how the tariffs are increasing. Yeah, we are still at the high end of tariffs. So all of this still needs to get into the economy with a delay. Is pretty bullish for gold, if you tell me. Yeah, this is also important news that the Chinese insurers can now allocate 2% to gold instead of 1%, and it could go to 10% next year. So if this happens, I think there will be a lot of demand for gold. Gold volatility, just some correlation that I found. Volatility is correlated to open interest. You can see the bottoms here. This is open interest, bottom in volatility, all bottoms here. And when you have a bottom, it will go up, and then gold will also go up. Okay, this is the gold price. We are currently at the bottom. So if this volatility goes back up, then gold will go up. Okay. China gold imports are stable, but it's trending down. So less demand. And that's also why I put a negative on this China demand. Stocks are overvalued. Yes, they certainly are, based on history. Some corporate data. You can see that the US dollar is going down in allocation. Swiss franc jumps. That's typically linked to gold. Copper is flat. Yeah, we know copper had a premium, but now it's back to zero. So everyone who bought copper has lost a lot of money, I think, if they bought at this top. Debt is increasing. Yeah, it's currently at 37 already, 37 trillion. And I think this is still from the last time. Already talked about this. We are still early in this gold bull market. And looks like my conclusion is really easy. Gold will go up for the next month, especially when we look at this heat map. The heat map, less red, more green. So yes, I think gold will be going up next month. Not sure about the amplitude. Yeah, let's just say that it will be a slow rise, maybe let's say 3,450 for the next month. Could maybe even touch the all-time highs, but it's not going to shoot to 4,000 or something. Okay, and I'll see you next video. Bye.